three piece of news came into the market for the recent weeks. One of them is to talking about the amortization. The second one is about the insured mortgage limit from 1 to 1.5 million, and third one is lower down payment for the first time home buyer. So all of the news are on the official media outlets. So you see here on global news talking about homeowners won't face mortgage stress test if renewal with a new lender. That's another fourth one, the test risk. So meaning, let me start with this news. The test stress test, which is still high, which they do that type of test when someone want to borrow from the bank in order to make sure when something like interest rate goes to 7%, if it goes to 7%, they can service their debt on monthly basis. That kind of test came back a few years ago, and seems they were preparing for such thing to happen. Bravo, Bank of Canada. That's why we have the best central bank of in the world, in my opinion. A compliment from a former banker. So that one will be waived or removed if the homeowner is renewing, meaning if they are renewing, they won't do that. So that was my concern in the past. I said if somebody is for a term of 3 or 5 years is paying on time, no problem, and interest is going up, especially when at up to 7% variable. So why we need the test again? Because we are on the downward. This test has to be removed only and only for those people already having a mortgage. For the new folks, because they are new to the mortgage and all of that, definitely as a banker, I'm saying you need a stress test. But how hard and difficult that test is going to be, I don't know. Whether they're going to change it and update it, I don't know. In my opinion, personal opinion, the ex-banker, they have to ease it a bit. The reason why my forecast for the next 5 years, we won't have an high interest rate as we had today. We reached just in the recent, and a few years ago, the Bank of Canada came, or OSFI came, with those stress tests because they forecasted, they could project this is going to happen in the future. But now it's the other way around. So, in my opinion, it has to be removed or is eased because it's unlikely to happen. But it's up to the OSFI. They have their own data and research. I'm not here to dispute. But the good and cool things is no more stress tests for someone who has a mortgage and want to renew. This is news number one. And news number two, the amortization. Again, that news came into the official outlet and media talking about the amortization. So, and one more thing, it was amortization, and then they about insured amortization. So, amortization, when you take a mortgage or a loan, there is two type of loans. There is a term loan and there is a loan with amortization. Like the amortization. So, when you take a loan, there is two things you don't need to mix up between. One is the repayment, which is we call it amortization. It could be 10, 20, 30, 15. In the past, I hear in Canada was 40, 45 years. And there is something called the term. So the term is the contract, the agreement between you and the lender, the borrower and the lender. It could be 1 year, it could be 6 months, it could be 5 years, it could be 3 years, it could be 4 years. So it depends. So the let's say example, I'm taking borrowing $100,000, but I'm returning, if it's term loan, I should return the principal plus the interest within, let's say, 5 years term from now. And by the end of the 5 years, my loans it has to be zero. But this is not the case when you go with the mortgages, with the houses. Why? Imagine in 5 years you have to retain the entire money you're taking. With today's rate, not just in Canada, most of the world, it is kind of impossible because the monthly payment is going to be very high. So the bank, what they came with, and it's okay with the Basel 1 and 2 and 3 and all kind of IMF monetary fund and all of that, okay with this, which is your term is different than your amortization. I know some folks, they are telling me in US is different. They have longer term, not 5 years like Canada. They have 15, 20, sometimes 30. I hear that. I'm not sure about those news, but that will ease their payments. So that's why their payments will way low than the Canadian payment. I got to check on that. I'm not sure about that. So The amortization, then example, back to the 100,000 example. If you take 100,000, you sign 5 years contract. Now you are not necessary to return it in 5 years. You are required to return in 25 or 30 years. Imagine the monthly payment is going to be as low as whatever, right? The downside of that is they're going to calculate the interest on 30 years, but they don't take an interest of 30 years upfront. They will be stick within the period, which is 5 years to period. Yes, it is reducing basis. I know many people that are saying reducing basis means they start to take higher portion of interest and they go down lower portion of the equity. As they go down to the amortization throughout the amortization period, is going to be at certain point the other way around, reaching the point the last few years or few months of the loan is going to be almost no interest, mostly principal. So this is how it works. So what they did, the best thing is to explain and give you a clear vision about this is to come to this calculator, which is payment amount calculator, is available on I think this is Dominion Mortgage. It's very simple and nice. So I put an example here, if you see in the screen, of 1 million loan to be paid monthly over 5 years mortgage term. This is what I was explaining. The interest rate came automatically. I'm assuming it's 4.64. This is variable, definitely. And well, by the way, it could be fixed. So if I say 25 years, I put it 25 years amortization, you see the monthly payment is going to be 5,612. And by the way, in this scenario, I did not put the down payment. I'm assuming the house price is 1.2, 20% down payment. The loan is 1 million. Now let's do it 800. If I'm taking 1 million, then my loan is going to be 800, right? So 800. Okay. It's a good example because most of the people buying million and below, then 20% down payment, 800 is the outstanding loan is going to be. So 800 monthly, 5 years term, 4.65 interest rate. The If we amortize it over 25 years, the monthly payment is going to be 4,490.26 cents. The term means during those 5 years, how much from principal you're going to retain is 96,000. The term interest, the interest on that during the time, wow, it's 173. The reason wow is because interest rate is very high here in this case, like 4.64. And number two is, remember I mentioned that you pay higher interest and you go down the roads, like higher. This is how the reducing basis concept. And I'll tell you why reducing basis by, I think, Basel 1 or 2 came into the picture. Back then, when people they were paying equal interest and equal principal, when the borrower get into trouble, they cannot pay their loan, the bank costs bear high cost to recover their loan, and their loss goes high and severe. And many bank back then they got into trouble. So that's why the IMF on monetary fund or Basel 1 or 2 3, I don't know which one, they changed the rule and made it reducing basis. I remember back then it was optional. Now most of the bank they do that for mortgages at least, or for term loan. Now, back to the calculator, you see the term interest plus principal is together. This plus this is going to be 269. That's what your cost of payment. End of the term, there's going to be 703 remaining. Means in 5 years from 800 is going to pay barely 100,000, which is most of people are facing today with high interest rate. Now, if I increase the period to 30 years with the new rules, look here. So your monthly from 4,490 is going to be 4,000, almost 4,000. Yep. So roughly around 500, 450, $500 less. So it's a big money for most of the people. But the downside of it, the interest is higher, right? The interest higher. The reason why, because you're going to pay. See, the outstanding balance. Remember there it was 730. Let's go back to that example. 700 something. Back to 25 years. See, the outstanding was 703. Here, the outstanding is at 30 years is going to be 730. Not that significant, but it is higher. Now, I'm going to come one day with a calculation. I'm going to prepare myself as usual on Excel sheet, and I want to prove to you, although you pay high interest rate on the longer amortization, the cycle of real estate in our market in Canada is not the way you think. You're going to end up with a debt. the most important is planning, structure, and timing. I'm going to come with that. How you enter having a mortgage, small mortgage, then your mortgage goes up, meaning your mortgage goes up means your lifestyle goes up. You start from condo, town, detached, then you downgrade back to condo, and you end up with debt free. That's what most of Canadians are doing, but nobody pays attention on putting it on an Excel sheet or something like that to show the people how it works, and people are concerned. I'm assuming not everyone is good with finance and mathematics. So that's a second in use. The third in use is the lower down payment. So for the first time buyers, they have came the federal government with exception to only start with 5% if they are qualified. Qualification is important, means the TDS, GDS, and all of that is only exception for the first time buyers. If somebody is renewing loan, or not first time buyer buying second or third home, or again or whatever, I don't think that's qualification. That this qualification there. This is a huge boost for the first time buyer. The fourth in use is about the insured mortgage. So when you borrow, when you take a house of $1 million, and if you are putting less than 20% down payment, you're mandatory. There's a mandatory insurance by the OSFI banks. You have to go to one of the three companies, with CMC, Genuine, and Canada Trust, I believe. If I'm not mistaken, one of the three companies, mostly are, I think all of them are crown companies, means owned by the government. They do insure the mortgage in case of one day there is no payment or something. They pay the outstanding, if there is any outstanding, not the entire outstanding. The difference between, let's say you buy a house for 1 million, then later on you sell it in the market less than 1 million, and there is a difference, market is going down, of 100,000. The borrower wants that money because it was insured. That 100,000 will be paid back to the lender. Okay, because in insured, nobody will come after you. Now, the thing is, when you put 20% and above, there is no such insurance. It's not mandatory. But what I was told by many mortgage brokers and bankers, that the banks, they go at the back end, they insure it by themselves voluntarily. They pay that. That's why most of the people, they say, I'm putting 20% down payment, but the rate is higher than if I put less than 20% down payment, because less than 20% down payment, you pay the insurance, is going to be added to the mortgage, not the HST part of it. The HST, there is a calculation for that CMC insurance, and you pay for a bit for it. You'll be added to the mortgage and amortize if you want, or you can pay it cash. But HST part of the cash. If you don't, the bank do that, and they will bear the cost in the interest. Nothing for free, right? So now the maximum insured mortgage was up to $1 million in the past. Now, what happened is they increased it from $1 million to 1.5, meaning they were up to $1 million. There was an insurance on it. Once you go up to that, above that, there was no insurance. So they increased it to 1.5 because the affordability, because the prices gone very high. So that's another in use. So we have four in use today, actually, not three. Four in use, tools or installments came into the market to ease and help aid. And on the top, the fifth one is interest rate itself cut, the amortization, the insurance, and lower down payment, and the of course the 5% we talk about. The one where if you renew your mortgage, you don't need to go through the interest rate test. Hopefully today's material was useful for you, and remember, we are heading to good market. There is no reason to hesitate, right? And the problem is knowing. I know there is a lot of information flooding here and there, but it's important to hear from experts, not just in on banking side, banking and real estate, which some are there. Gladly have the both backgrounds, and I can advise you, can plan things for you. Feel free to connect with me. My details and information below this video. Again, wish you successful real estate, and bye for now.